and welcome to this episode of Nucleus Wealth Empower, where I go looking for what the good life is and how finance can support and empower us in achieving that. So after a brief detour back into property last episode, we're going to continue with shares this week, and in particular, how to get started in share investing. And to do that, I have the great pleasure of sharing tea with the founder and CEO of Herconomics, Wadzanai Nenzou, aka Wadzi. So Herconomics is an education company focused on empowering Australian women who want to invest in the share market but feel intimidated to buy their first shares. Herconomics wants to empower women so they can build long-term wealth and live life their way. Wadzi has worked as a financial services professional for over 15 years in the areas of financial planning, superannuation, investments, banking, and compliance. She's currently working in the Wealth Concierge team for Bendigo and Adelaide Bank, where she's responsible for helping customers grow, manage, and protect their wealth. Wadzi, welcome to the show.
Excited.
So excited. We've waited so long, haven't we?
Oh my God, we waited so long. I was dying for this tea.
Turns out I haven't done such a great job of it. But I'm confident the conversation is going to be better than tea, and I'll make that up to you.
Well, cheers to that.
Cheers, Wadzi. Okay, so before we get into the show, I'd like to start by acknowledging the traditional custodians of country throughout Australia and their connections to the land, sea, and community. I pay my respects to their elders past and present and extend that respect to all Aboriginal and Torres Strait Islander peoples today. And a bit of admin before I forget that as well. So I'd like to remind everyone who's listening and viewing the show that anything we discuss today is general in nature and not personal advice pertaining to your personal circumstances. So if you have anything, questions or anything like that you'd like to discuss, you can always call myself and the team at Nucleus Wealth on 1300 623 863 or email contact@nucleuswealth.com. And we do love that if you're enjoying the show, if you want to give us a subscription, a like or a follow or that sort of thing and help the show grow, we'd certainly be really appreciative of that. So thank you. Okay, so we're going to start this conversation we have been waiting months to do.
I know we have.
I actually want to start, and it's the first time I'm going to ask this question on the show, but I've been wanting to for so long, and ask you, what to you is the good life and living the good life? Because I feel like in today's society, we're all so busy, and capitalism is sort of this subliminal message to be buying and spending, and that's what's going to make you happy. So when I was reading through, Herconomics and its goals, I really felt like this is a question I'd love to explore with you.
Perfect. I love this question. I actually listened to a podcast which is called The Good Life, and they asked that question at the beginning of it. So that's really good. The good life. That's such a good question. I would say personally, I would see the good life as living as aligned to your values or things that you value as much as possible. So, whether you're somebody who's like, I value family and relationships, or I value experiences, or I value nature, contribution, impact, whatever it is. I feel like the good life for that specific person or for each individual is you living as closely to those top and core values as you can. Because I feel like, and this is for me personally, when you're not living according to your values, you feel it.
Definitely.
It might not be very clear. You just know something is off.
You feel like heavy almost.
Yeah.
I mean, it's probably not the same for everyone, but
Yeah.
certainly I know when I astray from the path, I'm not sure what it is.
Yeah, exactly. So honestly, whatever your core values are, I feel that you'll have a really good life if you live as closely aligned to those values as possible. So that's kind of my definition of living this life.
I feel like we're so aligned. It's beautiful to meet someone who shares that.
Yes.
And so I guess when I think about that, I think about finances being about creating space so you can live those values.
Perfect. It's a tool, right? So a lot of people, that saying, money doesn't buy you happiness. I always counteract and say, yeah, money might not buy you happiness, but it's part of the equation. It's a tool around building a value-based life, right? A life that's aligned.
And the
to
freedom
what
to
makes it-
live that life.
Exactly. It gives you choices, it gives you freedom, and it's the tool. That's all it is. It's not evil. It's not out there trying to do anything. It's about how you use that tool for your benefit, for your loved ones, for your community, for the world as a whole.
I love that. It's not evil. It's
No,
a
it's
tool.
not.
So it's how it's
just a
used.
tool. It's
Yeah.
how it's used.
That's
Yeah.
fantastic.
Yeah.
And so, yeah, when I was reading about her economics, I felt like that is a really important part of what you're trying to empower people to do.
Yeah.
Does that sound about right? Or
Yeah, pretty much. I mean, I think for me, it's very much about people empowering themselves and, building a comfort level for themselves financially. And, in terms of comfort level, everyone has got different, goals, right? And different levels of what is comfortable for them. But there has to be basic financial security, right? For people. Even the people who say money doesn't buy you happiness, deep down they know. There's a level that everyone has to have where you're like, okay, I've got enough to take care of my basic needs. I've got enough to, have some luxuries here and there. But apart from that as well, it's about empowering women to know that they actually can build the type of life that they want to live. They can have freedom and choice to live life their way.
Yeah.
There's one of my, so this is gonna be a bit of a tangent.
Do it.
But one of my favorite songs is "My Way" by Frank Sinatra. Do you know that song?
I do know it.
I love it. It's actually I call my funeral song.
Very two-sided.
Literally my funeral song. I told my sister this just in case she survived.
Making other people's lives
That is, I like literally the lyrics of that song is like how I want people to say once they lived life her way. She might have made mistakes, she stumbled, she did this, but she lived life as, to the beat of her own drum, but also according to what her values were. So for me, it's pretty much what her economics is about, is to empower women to build the types of life that make sense for them and to showcase that they can do it, and that it's not, for somebody else, it's for them, it's for anybody.
That's so strong. I think this statement about encouraging people to live their way. All right. So when I was thinking, where do we start this discussion? I definitely thought about myself because we have such a similar background in finances. Superannuation, investments, compliance. I don't have as much in financial planning, but certainly at Nucleus Wealth, I'm getting some. And so I really resonated with that. But even though I have all that experience, even now, it's still daunting to me, the idea of choosing a share or choosing an investment.
Yeah.
And I know, coming through like investment teams, if they have a very strong fundamental process and they're building models, there's a lot of work that goes into it. I don't know if I got this concept from them of I have to do all the work before I invest in anything. It's just ridiculous. But I'm saying I can really appreciate when you feel intimidated or too daunted to buy first share.
Yes.
So let's start at that point.
Yeah.
What's the first step when that's where you are?
Yes, so that is so common for so many people, men, women, young, old, I don't care who it is. There's so much intimidation. When people think of the share market, like I think for you it's even worse because you've seen such hard work, like, in the background, you're like, I can't do that. That's a lot of work. And that's another myth as well, which we'll talk about later. But regarding or having to do all this work to actually invest in the share market. But I think as a start, I always think that it's important to. I do something funny. I do a funny exercise with my ladies when I do the course. And I say to them, okay, I want you to go and look at the ASX website, the first page, and just look at it like for like a number of days. Because first of all, a lot of people don't even want to go onto that page.
I can appreciate
it. Overwhelms them so much, right? It just overwhelms them. So I just want them to go and look at it. So that it's not this big monster.
There's so many questions there, right?
I know.
Like, what's an index?
Exactly. So before we even get them, like, let's not even go there. I just want you to see that this is not some big monster. I want you to just go and don't even click on any other page. It's just the front page of the ASX. And yeah, there'll be a lot of things that won't necessarily make sense to you because you don't know what the share market is. But first of all, I just want you to actually do that step of just going on there. But after you've slayed that dragon, which is pretty basic, I always say, okay, so this is the thing, right? A lot of people always think of shares. They think of Wolf of Wall Street. They've seen all these movies.
Oh, yeah.
They've seen this
Why am I so intimidated?
oh my God, you need to be like, in it. You're like going crazy, trying to pick the stock, trying to do this. And it's like, calm down. Most of how people invest is literally the opposite of that. But when you start out, the first thing is to just learn the basics, right? Like, don't try to know everything. So I find a lot of people are intimidated because they think of the whole journey before they even take the first step. So the first step is to learn the main basics. And by that, I mean like a very basic course you can do. So for instance, the ASX have got a shares course that they have. So there's actually an education center where, you can just learn the basics of shares or exchange traded funds or bonds or any of that stuff. So I always say to people, as a basic, before you start worrying about which share am I going to buy, what am I going to do, just go through that self-paced course. It's a free one on the ASX website. Just try to go through it. You won't understand everything, but just start with that.
Yeah.
Right? Just that. And before you even start thinking, oh my God, which share am I going to buy? You could also take advantage of things like micro investing apps.
Okay.
I don't know if you've heard of Raise.
Yes.
Yeah, so
We're
things
very
like
similar
Raise.
to Raise.
Yeah, exactly. So RAIZ, it used to be called Acons a while back, but I think it's a gentle way for people to kind of get into investing without using too much of their funds. So because they're like little amounts.
Okay. So what is the minimum amount you can invest in Raise?
So in Raise, what they do is you can do a number of things. So they have what they call the roundup. So you can purchase, let's say you buy coffee, right?
Yeah.
And you buy like for $4.60. Let's say I'm just putting the number out there. I don't actually
Sounds
don't.
right in Melbourne, doesn't
Funny
it?
enough, I actually don't drink coffee, but how did I know that amount? Anyway, so about $4.60, and then it will round up to, they'll say it's been $5, so they'll take the 40 cents and then they'll send it to your Raise account. And I believe they wait until it gets to at least $5.
Okay.
And then they'll put it into a portfolio of exchange traded funds, which is like managed funds. And that's a way of actually, indirectly investing on the share market. And I like that as a beginning. A lot of people, when they've become more advanced, move away from that. But I think as a beginning, it's a very non-intimidating thing. You don't have to make any choices. You're just learning a little bit about, what is this that I'm investing in? Obviously, whatever you invest in, whether it's Raise or anything else, always make sure you read the product disclosure statement or any fact sheet to just make sure that it's the right thing for you and you actually understand what you're investing in.
So how do you approach a product disclosure statement? Because this can be long, right?
Yeah, they are very long. Yeah, and boring. And very, very boring as well. So this is the thing. So for a lot of these things, they also have kind of smaller versions of PDSs.
Okay.
So for a lot of people, let's be honest, we don't really have time to read every single, thing about a PDS.
Especially if you're comparing products. Right?
Exactly. So if you're looking at PDSs, obviously you're trying, especially if it's an investment, you're trying to first of all understand, okay, how is this invested? Like you have to understand what they're actually investing in the first place. Yep. So get clarity on that. Okay. Get clarity on the risks involved. Get clarity on the costs, because all of this type of, whether it's exchange traded funds, which is an indirect way of investing in the share market, or managed funds or anything like that, would have some sort of ongoing management costs.
Yeah.
Just understand if there's any hidden costs.
And the PS has to document all of the costs.
Yeah, it does. And then also the benefits, they also mentioned the potential benefits that you get from investing in this. So I think that's like kind of like a high level important things, whether it's understanding what is the investment, what is the cost, what are the risks, what are the benefits, and who is the organization who's offering this? Are they a legitimate?
Okay.
authorized type of, are they a scam? You know, there's a lot of scams
Yeah.
out there. So
okay, I want to dive down into two things that you mentioned there. Let's start with this idea of legitimacy and how you verify it, because the internet has certainly made it easier for people to reach other people. And so how do you get comfortable that the organizations you're dealing with are legitimate?
Yeah, I think that can be really difficult, especially for people who are not in the financial world. I think for us, it can be a little bit easier because we understand authorized representative numbers, things like that.
Yeah.
So it's like, wait, I'm not really sure what that is. So I think one thing that you should do, or a good thing you should do, is when you're looking at it, I can only talk about Australia because every country is different. In Australia, when it comes to financial products, they're all legislated, or financial services, mainly legislated by ASIC, the Australian Securities Investment Commission, and they always want their legitimate financial product providers to be registered with them. So there's usually an authorized registration number of some sort.
Okay. Yeah.
And it will be there in the PDS somewhere, but also even on the website. Usually, if you look at the bottom of the website, they'll have like fine print where they'll say authorized representative, and then they'll mention the company.
Okay.
It might not be the name of the brand, but they'll have the company at the bottom of.
Okay.
They're using the authorized representative number of this person. So that's like a baseline of this is actually a registered.
So if you're seeing an authorized registration number, and what about an AFSL?
Yeah.
Does that help too? If you want to look to see that whoever's issuing it has his license.
Exactly. So that is
license.
Perfect. Yeah. So thank you for jumping into that because I was going to mention that.
I'll be looking at
No, that's really good. Yeah. Yes, that is actually really helpful as well.
Okay.
And AFSL is good. There's also a lot of these. They're supposed to have FSGs, financial service
absolutely.
guides.
You definitely want to see one of those.
You want to see that as well. So obviously PDS is good, but you also, especially with the financial product, you want to look at their financial services guide first of all to understand the type of, I guess, advice they can give you, or the type of products they can provide, whatever it is that they are registered to do, to understand what type of organization this is. I think that helps. If you don't see those things, run away. Like they need to, if in Australia, if you're a legitimate financial service provider, you gotta have those things.
Okay, so we'll put those in the show notes for anyone who's listening. Those documents, because there's a lot of acronyms and letters.
Put it in.
And it's as if the industry makes money out of confusing people, but you don't have to be.
And at least it shows, and that's not to tell you that this is an amazing investment and you're going to make money. It's just for the bare minimum. Actually, this is a authorized representative who's allowed to tell you or to sell this to you or to advise you in this way.
At the very least,
at the very
basic detail.
Exactly. It doesn't mean that they are, oh my God, that means that they are going to make me a lot of money and they're going to manage this property. That's not it. You have to still do your own due diligence. About their performance. Because as well, another thing you can do, obviously past performance doesn't mean future performance. It's always something I always tell people, just because the product has done this in the past doesn't mean they're going to do that. But at the same time, it does show how they've performed. Then you can see what they've been able to do in the past and what they're actually capable of. And you can have a look to see if it's something that you're comfortable with.
Performance to me is such a challenging and interesting conversation because, obviously with our financial services background, it's intimately tied with risk.
Yes.
But everybody understands performance. But risk is such a more challenging idea. And you were talking about risk before, and I was wondering, does the AFSL talk about that in any of its basic courses? And how does it demonstrate risk as a concept? How would you?
I mean, so in terms of, I guess, with risk, right, it's I think the basic thing is something that is, I guess, a best way of putting it as simple as possible. The risk that something might happen. And in the case of investments, there's a lot of different types of risks, by the way.
There are,
But I'm not going to go through all of them because that would just confuse people. There's a lot of different risks. I think that the easiest way of saying it is, let's say you put your money in an investment. You want it to grow.
Yeah.
You want it, you're putting that money for it to grow over time or to give you income, whatever it is. And when you think of risk, you're thinking of it not going according to that plan in some way. So it's the risk that, or the potential that it's going to deviate from what you wanted to do, whether you want it to grow over time, whether you want to get some income from it. There is that risk that that might not happen, or it might not happen as much as you want it to. So, for instance, let's say you put in money into a company, you buy shares, and obviously you're hoping that over time that's going to grow. But, let's say, whatever happens and then the company goes bankrupt, there is that's a risk that that could happen. And that risk is that you could lose, as a shareholder, probably most of your money. Or most likely all of it. But also another risk that a lot of people don't really think about is volatility risk. So let's say, for instance, you put in your money today, you buy a share in, Tesla or something else, and then, today it's whatever amount it is per share. Let's say 5,000. I'm going to put some big amount there. 5,000 a share, yeah. And then, and it goes up. Like it goes up to 10,000, and you're like, oh yeah, this is great. This is fantastic. And then next year, for some reason, it falls and it's now, $500 a share. It's really dramatically fallen for some reason, whether it's to do with the company or, the market, or we're in a recession or something.
I mean, we saw COVID affected all
exactly, COVID, pandemic, anything, right? And then that's usually okay if you still have the timeline and you're happy to keep the money in there for the long term. But sometimes you need money for whatever reason. Sometimes you need to cash out your shares because life happens. Maybe, there's an emergency, you can't cover it with your emergency fund, and there's a family situation and you need money out. So the risk there is that then you might sell it at a lower amount than what you purchased it as and make that loss. So you're not necessarily losing all of your money, but you've got that potential of losing some of it when you actually cash out for whatever reason you're cashing out as well. So there's, when it comes to risk, it's more a deviation from whatever you want to happen. And so you're trying to obviously minimize it as much as possible. So a lot of people, when they think of investing in shares, are only thinking of direct shares. Usually they're thinking, I'm going to buy 1,000 shares of Woolworths, but they actually don't realize there's indirect ways of investing in the share market with managed funds, for instance, and exchange traded funds. And this is actually products which are very good at minimizing risk for you, because within one purchase, you buy like a portfolio of a basket of shares or a basket of companies, or even asset classes. So it's not just shares. There could be, property in there, or there could be cash, there could be fixed interest. So there are ways that you can actually minimize that potential deviation that you're afraid of through different things, whether it's the type of product you're putting the money in, which actually has diversification. Put it in, in there. Or it's you making sure, even if you're buying direct shares, that you're not just putting all the money in one company, that you're investing in different companies, and also in different maybe industries and asset classes as well. So risk is always going to be there for any type of investment. Obviously, there's some, when it comes to level of risk, there's some that are lower risk than others. There's some, let's say, for instance, a blue chip company like CBA is a much lower risk than an emerging company in the developing world, for instance, in terms of the potential for you to actually lose out any money. So what's important about risk is you need to know yourself. So you need to know what level of risk you're comfortable with, because you could be someone who's not comfortable with risk at all. You're very low risk averse or low conservative investor. You could be a moderate or medium risk person. So you're comfortable with some risk, but you also want to balance it out with some low risk things. And then you could be someone who's very high risk because you're very much interested in getting as high growth as possible, and you're comfortable with volatility and things like that. So it's important to know that, because you see a lot of people investing in things that are the opposite of who they are.
Yeah,
And that gives you a lot of lack of peace of mind. You've got
absolutely.
blood pressure, going through the roof. That's not worth it. You need to actually invest according to your risk
Okay.
level.
So how does the person determine their risk level?
Yeah, that's a difficult one for a lot of people. There are actually questionnaires online.
Okay.
But I'm going to give a word of caution. A lot of those questionnaires are from product providers of some sort.
Yeah.
So what they
We
will
have one of
do,
those.
yes. So what you have to do is that, take advantage of the questionnaire and get the answer.
Absolutely.
You don't have to be forced to buy the product of that questionnaire afterwards. So you can try to get, because a lot of people don't know, okay, and you nailed it. Okay, yes, I don't like risk, but they don't really know how much they don't like risk in comparison to how the market views it. So they might think actually a moderate risk, but maybe they might be low risk,
Yeah.
So I think those questionnaires help.
I think the questionnaire is a good one, and I'm going to jump in and spruik us here in the a couple of reasons. Like when you do those questionnaires, you get a sense of how you're going to react to those situations.
Exactly.
That's what ours does. It asks you how are you going to react or feel in this situation, and that's how we
Do
get.
you want some more tea?
I love some. Thank you.
Yep.
So there's that aspect of it.
It's finished.
Oh, right. I know. It's a small thing. So how would you react in those situations? So that gives you an awareness of yourself. And then at the end, certainly know an hour on, will give you what your answers, what the recommendation in terms of percentage allocation to different asset classes. Yeah. And that is a pseudo risk score in a sense, because we think about equities as being the riskiest asset class, so you have more suggested allocation to that. You've got a riskier tendency, and vice versa to bonds.
Yes, exactly right. So I think for a lot of people who are true beginners, those questionnaires are lifesavers, because it's very difficult without those questionnaires for you to just know. Like, how do you know that?
Absolutely.
I think they're very, very good. But it's interesting. I agree with you that obviously in terms of the four main asset classes, shares, would be up there. But then think about new asset classes like crypto.
Yeah, I mean
that's like on another level.
That's what I was thinking before when you're talking about volatility.
Yeah,
the volatility has just been incredible.
That's the thing as well, right? There's a lot of people that I know of who are coming to me. They're not comfortable with volatility, but then they're investing in cryptocurrency, and then they're wondering why they're so stressed out. I'm like, you're going against your risk tolerance. Yeah. You can't tolerate this. You can't. At least in the way that you're investing in crypto. I think crypto is an interesting space, and it's gonna just keep on evolving. But they are actually looking at, or they have already started doing exchange traded funds, which are following crypto and stuff like that. And I think for a lot of people, those would be more likely where they should go instead of,
because it's a basket of crypto typically.
Well, actually, the one for beta shares, which is I think it's called. I think it's literally got CRPTO as in the code. They actually, what I like about that one, it's actually not following specific cryptocurrency. It's actually following the companies that actually are in the cryptocurrency industry.
Okay, so like they might be mining or
exactly.
Oh, fantastic.
I know.
So that's really important to read the tear sheet, the PDF.
Exactly, so that you can understand. Because someone might think, oh, they're following crypto. No, they're not. They're just following the kind of the engine behind it.
Yeah.
Things like that.
Which has much different drivers. Completely different drivers to the current cryptocurrency themselves.
Exactly. So so in terms of risk, just if you're not sure, go into Google and look for risk tolerance questionnaire. You can say risk level, whatever you want to put in there. And you come up with a questionnaire, or even try your questionnaire.
We'd love to have you try it.
And hopefully that can help you help people figure out where they stand there.
Okay. Yeah. Fantastic. Okay, so I have a couple more points that you've touched on that I want to dive into. Do you want to do that now, or do you want to kind of keep going? I know we're like going on tangents off the journey. What's your advice at this point?
No, I mean,
okay.
Tell me what's your
you talked about managed funds before, indirect investments such as managed funds, exchange traded funds or ETFs, and I guess I just wanted to talk a little bit about the great aspect of these, which is you don't have to pick the stocks yourself. So
Exactly.
either they're being selected according to an index, which would then generally be quite diverse, certainly more diverse than only holding one
Yes.
stock.
Yes.
Or in a managed fund, you might have a research team similar to Nucleus, like we do at Nucleus Wealth, and they're researching all of the stocks.
Yeah.
That's their day job.
Yeah.
They come to a view on it.
Yeah.
They put a portfolio together. And so it can be a first step in terms of getting comfortable with the process without having to take on all the burden and responsibility of it.
Exactly. I have a bit, I don't know if it's a controversial view or not, but I know a lot of people think, or a number of people think like this. Honestly, I honestly think most people should stay the hell away from direct shares. I'm going to just say it out there.
Well, I'm happy to say that, yeah.
I think most people should stay away from direct shares because they just do not have the time, the knowledge, to
it takes a lot of time.
Yeah, to research the company themselves, to figure out what is the, potential forecasted, they just don't have that interest, first of all, or the knowledge or the time or the curiosity to keep on learning, right?
Because it's not just the initial research. You have to stay up to date with all the announcements, not just the company ones, the industry ones.
Yeah, exactly. Just to stay on top of things. And
don't get people off. It's not the
Actually, funny enough, direct shares, especially if it's long-term investing, which is my focus, it's different from day trading.
Yeah.
So buying direct shares is not like Wolf of Wall Street style for long-term investing. It's not you sitting there the whole day trying to look at price charts. You obviously put in that initial stage of researching, you buy the company. You don't have to look at it every single day. You don't have to do that. So the time I'm putting out there is not like, oh my God, it's not doable.
Sure.
It's doable. It's more, you need to be more into actually making the choice yourself and putting that effort. And then, evaluating the portfolio going forward. Whereas, the things like exchange traded funds or managed funds, somebody else is doing that for you. Yeah, I mean, the caveat is that you pay them an ongoing management cost because, well, it's a service they're providing. But when it comes to things like ETFs, you can find some really low cost ETFs out there which have reasonably low fees. And the thing is, a lot of people always think
what do the fees range from an ETF?
Listen, they're so different because you've got passive ETFs, right?
Right, and you have active
and then you've got active ones. So that can be such a big gamut of like 0.07 all the way to like 3%. You know what I mean?
Yeah, okay, sure.
So it depends what the fund is doing.
Okay.
Because it's more of an index style, the cheaper it is because they don't have as much work that they have to put in.
Yeah.
The more it's active, as you'd understand, there's so much more work involved in
absolutely.
that. So that would usually cost more.
Okay.
But with exchange traded funds, or managed funds, a lot of people actually really underestimate what that can do. So for instance, I'll give an example. Let's say the S&P 500, which is the top 500 largest companies in America, for instance. I think there's a graph that I really like, which shows if you had invested $10,000, I think it's 91.
Yeah.
And it left it just tracking the S&P 500, like an index of the S&P 500, up to like 2020, or 2021, that it would have turned from 10,000 to 210,000.
Incredible.
If it, kept on reinvesting the dividends and all that jazz. So a lot of people think that they need to pick the next, unicorn, the next Tesla, the next Amazon or whatever for it to make sense to invest in the share market. But that's actually really incorrect because even if you're following just even the ASX 200 over the past 20 years, if you look at, the potential there, it's still going to generally, let's say just the share market has usually outperformed most asset classes in general over that long period, but also has gone past inflation. So another thing that a lot of people don't think about, one of the main reasons people invest is to try and actually make sure that their money doesn't erode over time.
Absolutely.
And you want to try and make sure that whatever that return is, it's going to be higher than whatever the inflation rate is, so that your money is actually growing in value. Exactly, or even more.
Yep.
So, so for a lot of people, it's like you don't have to actually necessarily choose companies if you don't want to.
Okay.
There's plenty of people who've built wealth just in managed funds, just in exchange traded funds, and allowing some other people to choose it for you. Although there's no either or, you can do both. I love both. I like both things. So
Okay.
you can mix both, indirect somebody else kind of, making those decisions for you for certain things. And then you can also choose individual companies as well. And at the beginning, be more cautious and maybe put in less money in things like individual companies until you actually really understand how to do the research for yourself. But you just have to start, right? I think a lot of people overthink
Yes.
investing.
Me.
By the way, I was one of those people. You're gonna laugh.
I
So,
don't think so.
you're talking about how you're in finance. I've been in the financial services world for 15 years. And I was, I would obviously do things like, managed funds through super exchange traded funds and other things through raise and other things. But it took me until my 30s, and I've been working in the industry for a while, to feel that I was good enough and I knew enough to buy my first direct share.
Yeah.
And then I realized, wait, actually, there was no need for me to have to wait all this long. All I needed was, a basic understanding, a basic way of knowing how to research and evaluate companies and understanding how the share market works. I had plenty of that working in this industry. But a lot of people, because of fear, they become perfectionists. That was me.
Totally.
I became a perfectionist, not because I didn't know anything, because I was intimidated. I was intimidated in finance.
And decision paralysis.
Exactly. And then when you actually make that first kind of step, you realize, okay, this is not as hard as I might think. It's actually more a psychological game.
Yeah, definitely.
The psychology part, a lot of people really don't put enough emphasis on that. So even Warren Buffett. So Warren Buffett, for those who don't know, he's one of the richest men in the world, but he's also known as probably the most successful share investor out there, long-term share investor. And he talks about how the most important thing he says, I think one of his quotes, which I really love, is the share market is a vehicle for taking money from the impatient to the patient. Temperament matters so much, especially in the long-term investing game. The psychology of your mindset, right? So if you're someone who's impatient and you want it all now, it's very difficult for you to actually wait out a great company that you invest in. You won't wait to see it grow over time. You want it now,
Yeah.
I'll give an example of Amazon. I think in 2013 their share price was like $300, which for a lot of people who had bought it before that,
Yes.
they would have been like, this is great. I'm gonna jump ship now, and that's great. But now it's like 3,000 something per share, right?
Yeah.
And for those who were patient enough to wait it out, and see where it went, they've been rewarded for it. And a lot of them have become millionaires from that. But psychology, because we're such emotional people,
Absolutely.
the share market and its constant volatility and movement, and of course, this world we live in where there's information bombarding you all the time. This happened and this happened. So you've got a lot of misinformation out there, first of all, but also there's a lot of noise. So we get emotional, we panic.
Yep.
We jump out, we jump in, we, hear from Uncle Bob and Auntie Liz at the barbecue about some amazing company she heard of, and then we jump in that because we are like,
Before we know what it is.
before we know,
'Cause we've
before
got
we
fear of
actually
missing
research.
out.
FOMO, exactly. You've got people talking about crypto. So this whole crypto thing is because crypto is everywhere, right? It's talked about.
Yeah.
And I say to people, what is crypto? They can't answer that, and they put money into it.
Oh,
So it's like,
that's scary.
I know it is scary.
I mean, it's okay, but it's better if you know what it is.
Please know
beforehand.
what you're actually investing in before you put your heart and money into it. So
That's
yeah,
exactly the thing, though, right? Because you have to give up time to work to get this money,
yeah,
and so be sensible with it.
yes.
I know that's nobody wants to hear be sensible.
I
with
know,
your
how
money.
rude. Don't tell them that.
Oh, the listeners just there.
Yeah, but it's true though. Like, just whenever somebody comes to you, with some amazing deal, just just take a breath, and ask some questions, get some more information about it. Do a little bit of digging. You don't even have to do much to unveil when something is a bit dodgy or if that person doesn't actually know what they're talking about.
And the time it takes to do that digging, you're not going to miss out on the whole thing.
No, you're not. And also, if it's too good to be true, if it sounds too good to be true, it is.
It definitely. Yeah.
I'm just gonna say, not that it's likely, it is.
Don't even do the work.
Don't even. If it sounds just too good to be true, it's a scam.
Don't worry about their AFSL.
Don't
or
go there.
FSG.
Don't even go there.
Yeah.
If someone's gonna tell you, oh, you're gonna be a millionaire in 6 months, run away.
Oh my gosh, yeah.
Stay away.
Why would someone tell you that instead of just doing it again for themselves?
Exactly right.
Yeah, okay. So psychology,
Yes. So work on yourself. Like, I mean, we all have kind of mindsets that we've gotten about money and investing from childhood, you know?
Absolutely.
Like we all do. I do. And everyone I talk to, the ladies, when I do the course with them, we psychology is a big part of the course. We talk about us mindsets and how we have to deal with them. And of course, the myths that we have about share investing. For instance, that is you have to be very smart to do it. You have to be good with numbers. You have to have a lot of money. All of this information, there's so much to counteract that. Is in there's literal examples of the opposite.
Why do these
of
myths
that.
exist?
I don't know, like there's a lot of media around share investing, which is not very accurate about the average investor. So the average investor is like, you and me, that's the majority of the investors. And these are the quiet ones. They're not the ones who are like Wolf of Wall Street. They're just normal average people who are employed, who are, buying, a number of shares and then they continue doing it over time quietly. That's more the reality of investing. That boring, mundane, I'm going to invest in whether it's an ETF or this, and then continuously add to that over a long period of time. The share market is such an exciting place. It's so noisy.
Yeah.
That the myths have come out of that.
Okay.
Whether it's from the TV shows, whether it's from the movies, whether it's just the media and what it says around shares.
I mean, because that's what people want to read and hear about. Like,
exactly.
It's sort of entertainment in a way.
Yeah,
that's why
exactly.
It's the same in, I guess, all about news.
And that's what intimidates people. They see all this and they're like, I can't do that. I'm just an average person. But there's so many amazing stories of average people who have changed their lives through the share market, through investing in companies over the long term. This has been going on for centuries, and most of the people who've made money on the share market are just average people.
Yeah.
With normal average IQs.
Also, I think on the idea that you have to have lots of money, certainly the cost of investing now, they've just come down so much with the internet. Like the cost of brokerage, buying shares or ETFs, that's come down a lot.
It really has. And if you are to compare it with other asset classes like property, where you have to, borrow God knows how much, and you have to save so much.
And the cost of the actual transaction.
So when people say to me, it's too, it's too much, you need to put too much money to start share investing, I'm like, really? That has to be probably one of the easiest or the cheapest or the lowest amount you need is investing in shares in comparison to things like property, So I always find that interesting, especially, and you nailed it, especially now with the online trading platforms and, the micro investing apps. There's so much that even with the most basic amount you can start nowadays. Yeah.
Okay. So, I don't think I have many more points to dive into, but I do want to do a recap and see if we've kind of got there for everything.
I think we probably went on some tangents there.
I need to know them all. Actually, you know what? Before we do that, do you want to talk about diversification? We touched on it a little bit. Is it worth talking any more about it?
Well, I mean, I think you guys would have probably heard that whole don't put all your eggs in one basket. So that's pretty much what that is. It's pretty much not putting too much into one thing, right? It's trying to make sure that, let's say this company goes down, it's not going to take all of your money with you, or this industry goes down, something dramatic happens, and it happens, and things change, and you don't want to be too, too much in just a focus of one thing, especially when you're the average Joe. So I say this as in, I think there's, I don't know if it's Warren Buffett or someone, if you're someone who's an expert, experts or people who know what they're doing can afford to be less diverse than people who are not.
But the difference between Warren Buffett and the average investor is often he has such large stakes in companies, and simply because of his reputation, he gets to have a say in the way that the company's run.
Exactly.
Like
exactly.
Active participant.
There's
in
actual,
the
you can
investment.
control a lot more than the average person can, right?
Exactly. As a small shareholder.
Yeah.
Like a couple of episodes ago, I was talking to the Australian Shareholders Association. You know, they try and sort of combine the retail power and pool it in terms of trying to get change at companies. So that's an example of how you can do that. But when you have less control, it's greater risk in a sense.
Exactly. And so yes. So exactly. So for someone who's just an average person, right? When you're thinking about diversification, is you're trying to just safeguard specific situations happening, making sure that, let's say, for instance, you can diversify in different ways. You can diversify in different asset classes. So not just having it all in shares, having some in property if you can afford it, having all in property trusts, or you can put it in bonds, whatever you want to do, or cash funds. But also you can invest within the shares themselves. You can diversify within that. So you can diversify with whether it's different industries or different countries. So you've got a lot of people, who've got most of their, money in Australia, right? But the world is your oyster, right? Take advantage of international markets. So market, regions, asset classes, there's different ways of just think of it as a way of covering your behind, in different potential situations were to happen. Normally with diversification, why it works, especially different asset classes, that usually when something happens, they can act differently to each other. So it can potentially cancel each other out. If something dramatic happens in shares, if you've got fixed interest style investments, they might act in a different way.
Direction.
Exactly. So that can kind of help you out there. So a lot of people are already, by the way, a lot of people don't know this, they're already indirectly invested in the share market, mostly through their super funds. So most super funds have, your money is invested in managed funds, and most of those managed funds have got money on the share market. So a lot of people don't know that, but you're probably already in the share market.
Fantastic.
Indirectly.
So, I mean, that can be a starting place as well. See what you can find out from your super fund about what you're
actually. Check out, actually find out how you're invested. A lot of people don't know this. Find out, they usually have different risk levels.
Exactly.
Conservative, moderate, high risk or growth. So find out and make sure you're comfortable with whatever, how you're invested.
Fantastic.
Yeah.
Thank you. And I love saying, don't have all your eggs in one basket. I feel like it summarizes it so perfectly.
Yeah, pretty much. That's it.
Okay, so let's have a quick look at where we've been today. So get on the AFX website.
Yeah, I mean, listen, if you start clicking on things on the AFX website, I think it can freak you out. But I like to do that. It's such a weird exercise, but it's worked when I've done it with the ladies, where they'll be like, oh, after a few days of just logging in and looking at it, the fear has gone down.
Exactly.
It's just gone down. It's like, it's okay. It's not the big,
it's not gonna
bite
and jump out of the
It's fine. You can jump in and out. And then secondly, just get some sort of basic. I would recommend the share course on the ASX, because they're not trying to push any agenda on you. It's just purely an educational course. And it's a basic course. I think it's important to understand the basics of how the share market works and what it is before you invest your money in it. So I feel really strongly about having some sort of basic understanding of what you're doing. And then just start. Please don't you don't have to put in a lot of money to begin with. You can use micro investing apps if you're not comfortable, or you can, invest the minimum of $500 in the online trading platform in a company you've researched, and then just learn more, take advantage of, if you find really good podcasts that you can listen to, like this one,
thanks,
then do that. You'll be surprised what you pick up on as time goes on. And if you find some people that you follow who've got podcasts, who've got books, who've got, and then you just the knowledge will grow with
Yeah,
time.
be
The confidence.
patient.
Be patient with yourself. Don't expect to know everything at once. It's one step at a time. And when you think of it as one step at a time, it's not so overwhelming.
Yeah, yeah.
And no one is holding a gun to your head to know everything now. Just do one step. Understand that those basics. Make that first purchase and just take it from
Do
there.
the questionnaire.
Exactly. Do the questionnaire. Understand your risk
So
tolerance
and then
and
learn
your
about
goals.
your psychology. Yeah, your
Yeah,
goals.
and your goals, and
Write them
understand
down.
write them down. What are you trying to actually get from these
Yeah.
investments? And
It's a
also,
great motivator, right?
yeah, and tie them back to your values. We talked about that at
Where
the
we
good
started.
life at the beginning. Tie all this back to why are you doing this? I always do a kind of practice, or what do you want to call it, activity
Yep.
at the beginning of the course with the ladies, where it's like, what is your big why? What is your big why for investing in the share market? And it can't be, oh, I want to make money. It has to be a deeper need around your values and things that are really important to you. And then when you really know that, it can help you just continue on, with it as well.
Fantastic.
Yeah.
Thank you for sharing all of your wealth of knowledge.
Thank
And
you.
so much that's from your course. If people are interested in your course or following you,
Yeah.
how can they get in touch?
Okay, so you can follow Her Economics on social media. So whether it's Facebook, Instagram, you can follow on LinkedIn as well. And obviously, you can follow me on LinkedIn as well. Another way, a really good way, is you can go to the website and join our email list. So hereconomics.com, so they can actually follow the email list. So that way you find out when, because I do like educational free webinars occasionally, and then of course you also find out when the course is going to be, the next cohort. So yeah, so follow me and come and register for the email list.
Thank you.
Yeah,
You heard her. Get on it.
come on, guys.
All right, so let's close out the session.
Yeah.
I hope you've all enjoyed it as much as I have, because it's been fantastic. And if there wasn't something for you, maybe you know someone who is a little bit tentative about getting in the share market, and you could share it with them. I just wanted to remind everyone that Nucleus Wealth does personalized investment portfolios and limited investment advice. That's the questionnaire we've been talking about all episode. And you can find out more at nucleuswealth.com or give us a call on 1300 623 863. You can ask us questions or anything like that. Don't have to necessarily be wanting to get invested with us straight away. Thank you, as always, to my producer, Jaden Stent, for his help in getting today's episode out. Yeah, that's goodbye for myself and Wadsy today. Thank you for listening in.
Awesome. Thanks for having me.
Thank you.
Lovely.
It was a pleasure.
Thank you.